Welcome to the UK Mortgage Market Insights for the weekend in the 8th of May 2026. I hope you've all had a good week and you've got nice plans for the weekend. If you're new here, please do hit subscribe because every Friday I run through everything that has moved in the mortgage and the housing market this week so that you know exactly where things stand. Right, we've got loads to get through today, so let's go. So first up, on mortgage rates this week, a couple of lenders have made some minor tweaks and Halifax, HSBC and Santander all announced some small cuts, which on the surface sounds encouraging, although there have been a few lenders that have thrown in some increases. But I want to be really clear about context here because context is everything. Yes, lenders are nudging rates, some down, but overall mortgage rates are still sitting more than 1% higher than they were before the conflict in the Middle East escalated. So while any movement downwards is welcome, we are nowhere near back to where we were at the start of the year. So don't let the headlines about rate cuts trick you into thinking that the market has settled down because it hasn't. Not yet anyway. So before you make a decision based on those breaking news posts that you keep seeing, seek some proper advice so that you don't make the wrong decisions. Okay, let's talk swap rates because as you all know, these are what actually drive fixed rate mortgage pricing. And this week we have seen some slight movement. The 2-year swap rate closed yesterday at 4.141%. Last week it closed at 4.243. So that's a drop of just over 10 basis points across the week. The 5-year swap closed at 4.142, down from 4.219 last week, about 8 basis points lower. So modest easing across the board. Welcome, but modest. What I find really interesting though is where those two rates now sit relative to each other. 4.141 on the 2-year and 4.142 on the 5-year is essentially flat. The curve has completely flattened. Now normally you'd expect the 5-year to be noticeably higher than the 2-year to reflect the additional uncertainty over a longer period. When they're this close together, it tells you that the markets genuinely don't know which direction rates are heading. There's as much uncertainty priced into the next 2 years as there is into the next 5. And that's a pretty telling signal about where we are right now. And it's worth remembering, Nationwide's chief economist noted this week that even with recent movements, swap rates remain well below the highs that we saw in 2023. So the Middle East shock has been a partial reversal of progress, not a complete undoing of it. But partially still significant when you're trying to buy a home or remortgage. Now, there's been nothing dramatic this week on lender criteria, but the pattern we have been watching for several months continues. Lenders working in smaller tranches, managing their books carefully and repricing quickly when swap rates move. If you're sitting on your hands waiting to decide on a product that works for you right now, don't assume that it will still be there next week. That's just the reality of this market, so make sure that you move quickly. Moving on to the economic data this week, and there is quite a bit to get through. First up, Nationwide published their April house price data last Friday. On the headline, annual growth picked up 3% in April from 2.2% in March. Month on month, prices were up 0.4%, with the average price now sitting at just under £279,000. Now, Robert Gardner at Nationwide described this as a market regaining momentum, but I want to push back on that a little bit, gently but honestly, because when you actually look at what else is happening, the picture is a bit more complicated. GfK's Consumer Confidence Index has fallen to its lowest level since late 2023. Riggs reported a sharp fall in new buyer inquiries in March, the weakest reading since 2023. And those are not the numbers of a market in good health. And frankly, what I'm hearing from my clients backs that up. Properties are just sitting there. Sellers aren't shifting. People can't find anything at the right price. So either we still have sellers pricing delusionally, which some absolutely are, or there is an underlying affordability problem that the headline price growth number is masking. I think it's the latter, and I don't think that eases meaningfully until the situation in the Middle East stabilizes and energy prices start to come back down. Nationwide themselves even acknowledge this. Gardner was careful to say that the resilience is partly down to household savings buffers and historically low debt-to-income ratios. But he was also honest that those buffers are not evenly distributed. Not everyone has that cushion, and the people who don't are feeling it. Next up, UK Finance published their Lending Where We Live report this week, and there are some really important numbers in here. 723 house purchase mortgages were advanced in 2025. That was up 17% year on year, which is a solid number. But here's the one that really stands out. The average UK borrower is now spending 21.3% of their gross income on mortgage repayments. That's the highest level since 2008, so let that sink in for a moment. And it's not evenly spread. If you're in North Norfolk or the London Borough of Hillingdon, borrowers there are spending over 25% of their gross income on mortgage repayments. Right here in East London, Barking and Dagenham sits in that least affordable top 10 at 24.3%. Luton, Slough, Spelthorne, Havering, Harrow, they're all up there. The commuter belt is being squeezed hard. Scotland, by contrast, dominates the most affordable end of the table. East Ayrshire, Inverclyde, North Ayrshire, borrowers there spending around 17% of their income, nearly 9% less than the worst affected areas, and that's a significant gap. London borrowers carry the highest average mortgage debt in the country at £280,000, nearly £70,000 more than the South East, which is the next highest region. Now moving on, there is also a really interesting report out from the Mortgage Works this week, specifically for landlords and anybody thinking about buy-to-let. Over half of private rented stock, 51%, is now rated EPC Band C or above, up from just 25% 10 years ago. So that's a significant process. But the 2030 MEES deadline is coming, and that requires all rental properties to hit Band C. So if you're a landlord sitting on a Band D or below rated property, the clock is ticking. Here's the commercial reality though. An A or B rated property now commands an 8.1% rental premium over a comparable D rated property. And on a typical rent of around £1,075 a month in England, that's roughly £85 more per month. And on purchase price, landlords are paying a 12.2% premium for A or B rated stock. In the north of England, that premium rises to 19.1%. So energy efficiency isn't just a compliance issue, it's increasingly a commercial one too. The gap between an efficient property and an inefficient one is widening in both rental and capital value. One word of caution on upgrades though. Pre-1919 properties, which make up nearly a third of all private rented stock, cost on average around $10,700 to bring up to Band C. That's a meaningful number, and if you breach the MEES regulations, fines can reach £30,000 per breach per property. So this needs proper planning, not a last-minute scramble. Now, the ONS also released their Business Insights survey this week. Nearly 4 in 10 businesses, 38%, say they are concerned about the international conflict impacting their supply chains over the next year. That's a 28 percentage point increase since December. A quarter are concerned about shipping disruption. These numbers are a reminder that the Middle East situation isn't just an energy story. It's feeding through into business confidence and operating costs more broadly, and that has implications for the wider economy and for inflation. So, as usual, let's bring it all together and see what this all means for you with Craig's market view. Well, we're in a market defined by uncertainty right now. Rates are marginally easing. House prices are holding up on the headline numbers, but beneath the surface, affordability is stretched to its tightest point since 2008. Consumer confidence is weak, and the Middle East situation is still the dominant force driving swap rates, energy prices, and inflation expectations. Until that picture changes, I don't think we see any meaningful sustained improvement in mortgage affordability. And I also want to highlight the question that I get asked more than any other right now. Should I fix for 2 years or 5 years? My answer is always the same. That is actually not the question that you really want to ask. Your real question is, what's going to happen to interest rates over the next 2 to 5 years? And that is a completely different question. It's one that nobody, and I mean nobody, can accurately predict. Not me, not the economist, not the Bank of England, because if anybody could, we wouldn't be in the position that we're in right now. So my answer, as always, is never pick a rate based on what you think might happen. Base it on things that are confirmed and definite. Things that only you can control. Your own circumstances, your affordability, your plans, your hopes, your dreams, your wishes. That's what should drive the decision, not a guess about where rates are going. So who can benefit the most right now? Well, for first-time buyers, this is genuinely still a strong buyer's market. Yes, rates are higher than we'd like them to be. But here's the thing. If you could negotiate £20,000 or more off a purchase price, you have created instant equity and instant profit. And that equity gain is going to far outweigh the short-term cost of slightly higher mortgage rates. Motivated sellers are still out there. Thinner buyer pools means that you have negotiating power, so use it. For those coming off a fixed rate, get advice early. Don't wait until you're rolling onto the standard variable rate. With rates moving at the speed they are, having options ready is essential, so the sooner you start, the better. And for buy-to-let landlords, the Renters' Right Act came into force on the 1st of May, just last week. If you're a landlord who's been on the fence about your portfolio, now is the time to make a decision. And here is something that not many people are talking about yet. If you're a tenant and your landlord has indicated that they may want to sell, you could be sitting on a real opportunity. If you are in a position to buy, you may well be able to negotiate a discount on that purchase price to help the sale move quickly. That discount can be used as your deposit. You already know the property, you know the street, there are no chains to worry about on your side, and that is a genuine chance to get on the ladder on favourable terms. Well, that's everything for this week. As always, if you have any questions, please drop them in the comments below. And if you found this useful, please share it with someone who needs to hear it right now. There are a lot of people making big decisions in a very uncertain market, and the more people that have access to honest, straightforward information, the better. I'll see you next Friday, so take care.